One of the biggest questions that I get asked as a financial planner here in the UK is, should I take my tax-free cash or should I leave it in the pot for a bit later on? Now it all sounds simple because it's tax-free cash. Why wouldn't I just take it all? But the truth is, there's good reasons for and against taking your tax-free cash all as one lump sum. And today I'm going to share the reasons why you might want to consider taking your tax-free cash as soon as you can, and why the right answer entirely depends on your own circumstances. Hi, I'm Gareth Shears. I'm a chartered financial planner here in the UK. And for over 18 years, I've helped people just like you plan and retire comfortably. And today I'm going to cover the 5 reasons why I think you should potentially consider taking your tax-free cash. Okay, number 1 is you actually need the money. Probably one of the most obvious reasons why you would take it. Now, for many people, retirement assets are mainly their home and their pension pot. Now, the home isn't that tangible and you can't really just sell a doorknob, but your pension is something you can actually access and use that to plan your daily retirement. Now, taking your tax-free cash could mean you have that pot of money to use for daily needs and lifestyle expenditure. Now, be mindful if it's a defined benefit or a final salary scheme, by actually taking more tax-free cash, you are reducing your income. So it is worth taking some advice on which is the best option for you for that. But now, taking your tax-free cash, why this could be relevant during retirement is you could have some debt to pay down, maybe a mortgage or loans, or maybe some car finance you want to pay off, or maybe you want to buy yourself a holiday home. So that's what that could be used towards. Now, number 2, we just discussed this in the last one. If you've got a defined benefit or final salary scheme, these are some of the things you may want to consider when you're taking your tax-free cash. Now, some schemes may just force you to take one set lump sum. Others may give you options on sliding scales of actually 0 tax-free cash, right the way up to the full amount you can take, or partial amounts in between. And all of these will depend on what actual final income you get from that type of pension. And you've got to be mindful of what we call a commutation rate. Now, all these final salary pensions have these, and that works out how much of your annual pension do you give up per pound of lump sum that you actually take. Now, when you're taking your tax-free lump sum from your defined benefit, in most people's cases, it'll probably be benefit to take all of it at the highest amount you can take as a tax-free lump sum. And then you have the option of investing that money to make it grow for retirement, or you can use it to just substitute your income that you've got, because it will change from what you're originally taking when you're employed. Each person's circumstances will be unique to them. So that's why I'd always say, get some advice from a financial planner that can help you with that. Number 3, balancing pensions with other assets. What we find is many retirees are very pension heavy with the money they've got. They don't have any other assets like ISAs or other investments that may be able to use to bolster their retirement. Now, that creates a risk, because if you take all your tax-free cash, all future withdrawals from your pension then are going to be taxable, which means that in some instances when your state pension kicks in, that may push you into a higher rate tax band. And also, if you are investing that money and you're not investing in ISAs and it's just in your account, you will have to pay tax on any of the money that you make from that. So the idea is, if you can get the tax-free cash out, you've got to try and get it into ISAs as quick as you possibly can. But also be mindful you are only limited to 20,000 a year. So this could take some time if you have a substantial lump sum pot. You know, by doing that, we are building an element of tax-free money, which is easily accessible and flexible. And also, we're kind of spreading the risk of where we've got all our money, not just all in pension. Now, number 4 is managing your income in retirement. So let's take an example of a £200,000 defined contribution or personal pension pot. Now, you can take from that, under current rules, 25% tax-free cash, assuming you've just got the basic tax-free cash available. There are some older pensions where you may have a high element of tax-free cash. But for this instance, we're going to talk about the basic 25%, which would be £50,000. And you could drip feed that out to subsidise your income, or you could drip feed it out and add it into ISAs over a period of 2 or 3 years. And then later that money then is grown in a tax-free environment where you can draw it without paying any additional tax on it. Now, this helps to give you a little bit more control and flexibility of how you draw your income for retirement. You need to compare this to leaving all your money in the pension, because bear in mind, allowances are not increasing at the moment with fiscal drag, so therefore you may end up paying more tax on some of the money you pull out, pushing you to the higher rate. Number 5, beneficiary considerations, especially with the 2027 rules potentially coming in. Now, up until now, pensions were outside the estate for inheritance tax, but under new legislation that's coming in 2027, this is all going to change. Pension now going to be calculated back in for inheritance tax. Now, that means the old planning rule of trying to keep your money in your pensions if you didn't need them for inheritance tax planning purposes, this now is going to have to change. Now, if you have no beneficiaries, it probably makes more sense for you to spend as much money as you possibly can for it anyway. Albeit, yes, they will be taxed if you leave it to beneficiaries, and it will be formed part of the inheritance estate. But the idea of your pension is you need to spend it, okay? It's not there as a tool to pass down the line. Really, you should be using it to substitute your lifestyle and enjoy your retirement. Go on those holidays and do those things you've always planned. Now, if you do have beneficiaries, be mindful if you have a defined benefit scheme, if anything happens to you, pass away, if the children are no longer dependent, that pension will only go to the spouse. And if the spouse passes away, the pension will end. So that's why it may be better for you to take as much tax-free cash as you can from a defined benefit scheme at the outset, because it's already in the estate. Now, I know we talk about inheritance tax, but let's be mindful that, yes, you could be taxed 40% or even more on if you're over 75, but surely it's better to have 60% of something rather than 100% of nothing. So there's plenty of reasons there of why taking tax-free cash could be a benefit to you. Paying down debt, living a better lifestyle in retirement, or putting some money away, or even passing that down to beneficiary. You know, the key to this is your decision, and you don't want to look back and regret that you didn't do the right thing in retirement. So that's why I'd always suggest that you try and find a financial planner and get some advice on that. Now, next week, I will be doing a video which will do the opposite of this, why I suggest you shouldn't take tax-free cash at the outset, and then you can make your informed decision from that. Now, if you found this video useful, please hit subscribe and like, because that'll help me grow and share the message around my channel. Thanks for watching. I'll see you in the next one.